This week, the Australian dollar rose from around 75.50 to near 77.50. It was supported by both local and international data releases. Q2 GDP rose 0.5% over the quarter, and annual growth strengthened to 3.3% from 3.0% in March. This was driven mostly by the surprisingly strong public demand as state governments increased investment in public projects. There is a risk, however, of a correction in public spending in the second half of this year. Meanwhile, consumers were shown to be more cautious, and the quarter was disappointing in terms of both income and spending. The impact from the mining sector was neutral, with a boost in exports offsetting the continued drag in investments. Overall, the report showed that growth was above trend, the economy expanding at the fastest pace since 2012. This reinforces our view that the RBA is unlikely to cut unless we have a large downside surprise in inflation. Markets are currently pricing around 40% of another cut by December. We also saw the release of the July trade balance numbers, and the deficit shrank to 2.4 billion. While resource volumes have been rising, the prices of metal ores were surprisingly weak in the month. Exports were driven mostly by a surge in gold. Internationally, the US ISM Services Survey was weak. It showed a large miss and is at lows since 2010. The details were also disappointing, with employment and new orders falling. This came after an underwhelming non-farm payrolls report on Friday. There was a smaller gain in jobs than expected, and annual growth in wages slowed. The US dollar weakened as this reduces the chance of a September Fed hike. Markets are currently pricing in less than 30% of a move in September. In the week ahead, the August employment report highlights the domestic data calendar. We expect jobs to grow by 15,000 and the unemployment rate to hold at 5.7%, equal lows since 2013. In Australia, there's also the NAB business surveys and Westpac consumer sentiment. From the US, we will see retail sales, CPI, and regional manufacturing surveys. These have the potential to shift Fed hike probabilities, but only if they are exceedingly strong. The Aussie should also continue to be supported by commodity prices. Most notably, coking coal has risen by around 30% since the beginning of the month. Thus, we should see the Aussie supported on any dips towards 75.50, and 77.50 should remain the top end of the range. We'll speak to you next week.